Gold has traditionally been both a store of value and a medium of exchange. That's important to understand. If that's right, you could be talking about a gold price that was $7,000 or $8,000 or $9,000 or $10,000. Am I saying gold is going to go to $10,000? No, but I'm saying that there is a strong enough possibility of it, and the consequences of that for you maintaining your lifestyle with a US dollar denominated balance sheet would be very unpleasant. So I think that people who are concerned about those things need to own gold. And I think that message circulates well. And I think for better or worse, the gold price goes higher and perhaps much higher.
Throughout March and April, the gold price broke new barriers, with each all-time high headline quickly followed by another. Central banks, recognizing the risks in the market, have been strong buyers of gold for some time. They acquire gold to shield themselves from geopolitical and currency risks, which can wreak havoc on reserve values when currencies fluctuate. Notably, major countries like China have been bolstering their gold reserves, signaling to the market that even governments are prioritizing physical gold as a safeguard for their reserves. Central bank demand has remained robust, with reported global central bank gold reserves rising by 19 tons in February alone, marking the 9th consecutive month of growth. Rick Rule, founder of Rule Investment Media, highlights the importance of considering inflation-adjusted gold prices. While many celebrate new all-time highs in nominal terms, true real highs, adjusted for inflation, remain higher, with gold needing to surpass $2,700 to achieve them. This distinction underscores gold's enduring significance beyond mere price fluctuations, serving as a cornerstone of financial stability. Escalating debt levels, particularly in the United States, underscore gold's role as a hedge against fiat currencies' purchasing power erosion. With the gross federal debt amounting to $34 trillion and the US dollar losing 98% of its purchasing power since 1971, gold has proven its resilience in maintaining value over time. The erosion of the dollar's purchasing power could fuel a surge in gold prices, potentially reaching unprecedented levels. Rick highlights that while specific price targets remain speculative, the rationale for owning gold remains compelling. Central banks, including China's, recognize gold's enduring value as both a store of wealth and a medium of exchange, particularly amid geopolitical tensions and economic uncertainties. As the global landscape evolves, gold's role as a strategic asset is poised to gain further prominence, offering investors a reliable hedge against financial instability and currency devaluation. We will present clips from Rick Rule's interview with ITM Trading. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The first thing is when people say that gold is broken out to new all-time highs, they're talking about nominal highs, not inflation-adjusted highs. Work that I have seen by the World Gold Council suggests that in constant dollars, that gold would have to break out above 2,700 to get to new real highs. It's interesting that when people talk about money, they don't talk about money in terms of the constant. And when you talk about gold, you are talking about the constant. So my suggestion would be for gold to take out the old highs, which I think it will do, it would have to go through 2,700. For me, gold isn't a trading vehicle. For me, gold is a store of wealth, a medium of exchange, liquidity, and insurance. And I own gold because I'm afraid of our incomprehensible debt levels. I own gold because the interest expense of the US government, I say the US government, but I could just as well say the EU or Canada, is going to overwhelm our ability to sustain it. I'm old enough, Daniela, that I remember the decade of the 70s. We dealt with it by inflating away the purchasing power of the instrument that the debt was denominated in. Over the course of the decade of the 1980s, the purchasing power, constant purchasing power of the US dollar declined by 80%. I think that that sort of thing is precisely what's on offer now. If that's right, and I believe it's right, if that's right, you could be talking about a gold price that was $7,000 or $8,000 or $9,000 or $10,000. Am I saying gold is going to go to $10,000? No, but I'm saying that there is a strong enough possibility of it and the consequences of that for you maintaining your lifestyle with a US dollar denominated balance sheet would be very unpleasant. So I think that people who are concerned about those things need to own gold. And I think that that message circulates well. And I think for better or worse, the gold price goes higher and perhaps much higher. Gold has traditionally been both a store of value and a medium of exchange. While it doesn't provide a yield like US Treasuries in terms of being a savings instrument for the Chinese central bank, it provides them more security of principle than other currencies of trading partners that they may have, the Russians as an example, or the Chinese. So gold is, I think, for the Chinese central banks and for many other central banks, fulfilling its traditional role, both as a medium of exchange and as a store of value. Imagine if you were the Chinese and you ended up with several trillion rubles and you didn't have the ability to spend on anything from Russia. When it was efficacious for them to denominate their trade in US dollars, they did it, and they did it comfortably for years, and they were for years the largest holders of US treasuries. The relationship between the US government and the Chinese government now probably leaves the Chinese no choice but to reduce their holdings of US treasuries and substitute gold for that asset class.
Central banks globally are ramping up their gold purchases, hitting a record in Q1 2024 with a net increase of 228 tons in official gold reserves. This surge, exceeding the previous Q1 high set in 2013, marks a substantial 68% rise compared to the 5-year average. The recent spike in gold prices, reaching all-time highs, is partly fueled by investor expectations of a US interest rate decline. Central bank gold buying, which began in 2022, has further buoyed this trend. While China has witnessed more retail gold buying than the US, foreign central banks have been the main drivers of significant gold purchases. Rick sees that this shift in purchasing behavior is influenced by geopolitical dynamics, such as US efforts to assert dominance through tactics like sanctions and currency weaponization. Meanwhile, the silver market has experienced some volatility, with the price of silver falling back sharply to $26.20 amid attempts to surpass the crucial resistance level of $27. While silver typically follows gold's lead, recent events like the 2020 and 2021 silver squeezes have created opportunities for speculative gains. Despite this, Rick suggests that gold remains a vital component of diversified portfolios as a hedge against economic uncertainty, while undervalued silver stocks offer potential for investors seeking speculative opportunities. Let's get back to the interview.
The recent strength in gold, and by recent I mean the last 2 years, has been more a function of central bank buying than retail buying, even in China. The Chinese market, and to a lesser extent the Indian market, has seen more retail buying than the US market, which has in fact seen retail selling. But the statistics would suggest that the buyers of gold in real size have been foreign central banks, reacting, I suspect, by the US government's attempt to weaponize the US dollar, whether it is seizing $300 billion worth of Russian holdings of US Treasury securities, which should make any country that holds its wealth in US Treasuries concerned, or the weaponization of the SWIFT banking system by the US to reinforce sanctions. Whether or not, as an American, you agree with those policies or not, they're disquieting to foreign central banks who have suddenly come to understand that denominating all of their foreign currency transactions and their national savings in US dollars and US Treasury securities is not a good thing. With regards to the difference between Chinese buying, that is Chinese retail buying, and US retail buying, the Chinese government has an official policy of encouraging their savers to save, among other things, in gold, which is to say that they have facilitated gold transactions and encouraged it after a policy many years ago of making it illegal. So there's probably an awful lot of pent up demand in China, which is also facilitated by the Chinese government. And as you say, the weakness in the renminbi has meant that while gold has done well in US dollars, it's done very, very, very well in renminbi. What I told people about silver was that traditionally silver followed gold, that gold needed to move, that the narrative needed to be established by gold, and then silver would follow through. What I tried to say in the interviews that I think you're referring to were that the silver stocks were truly a coiled spring. There was so much hate around the silver stocks, probably as a consequence of their fail during the 2020 and 2021 silver squeeze. I like to say there's no hate more sincere than the hate of a jilted lover. And silver and the silver stocks certainly built up a lot of jilted lovers, young jilted lovers, particularly passionate ones in 2020 and 2021. The consequence of that is that the silver stocks got way, way oversold. In my career, that's happened 3 times before, and I'd adore to see it happen again. I own gold, or physical bullion, I guess, as insurance. I own the silver stocks as a speculator, and describing them as coiled springs, I think is really accurate. There is not enough market cap in the legitimate silver stock space to handle the capital that will come into the space if the generalist investor buys into that narrative. I've seen that happen before.
With robust demand for gold from emerging market, EM, central banks, and Asian households, strategists at Goldman Sachs are maintaining their base case projection that the precious metal will rise to $2,700 per troy ounce by the end of the year, marking a substantial 17% increase. This forecast underscores the ongoing appeal of gold as a safe haven asset amid global economic uncertainties, suggesting a bullish trajectory for gold in the coming months. Share your thoughts on Rick's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.